large businesses can sometimes be viewed in terms of segments. They could be geographic, they could be in terms of product line. Maybe you have like the professional grade versus the consumer grade, or some other feature that distinguishes them from other parts of the company's mission or operations. If you think about it in terms of a company that has stores, chain stores all over the country, they might look at each individual location as a separate segment, or maybe they look at them geographically in terms of like the South or the Northeast or something like that. And they may say to themselves, well, is this segment profitable? Because even though they may run as entirely sort of freestanding from a certain respect, there are still overarching costs that will be common to all of them. The advertising, the ordering, anything like that, the planning for the entity itself, all of that may be done at a much higher level and impact all of those, but they will all have their own individual costs and will all need to ensure that they at least aren't losing money in these particular segments. So as I said, you're going to have these common fixed costs. You're going to have advertising that applies across, maybe it's across the country or across the region. And it isn't just for an individual store or location, but it is brand recognition across um, all of the stores. And you will have strategic planning, accounting, insurances, all of those things that are dealt with at a much higher level in the sort of the parent organization, where an individual on the ground manager might not necessarily have any control over what the corporate office is spending on corporate salaries and things like that. So sometimes a company needs to look at a segment. Again, it could be geographically or it could be by product line and say, is this profitable? Should we continue to maintain this, or should we buy this segment? Should we acquire it? We'll look at this example. We've got the Acme company, and they've got three retail divisions. They've got small, medium, and large. Um, and then they've got sales, variable, and fixed costs for each of those divisions. Now, included in those fixed costs, they have allocated $5,400,000 in common costs that they split evenly across each of those segments. Now, if you are Acme, is this going to be the best way to allocate these common costs? I mean, think about it. If each segment isn't necessarily using the same proportion of those common costs, is it fair to saddle them with that large a share? If the small segment, for example, can't charge as much for the same item as the large segment, is it fair to saddle them with an equal proportion of those fixed costs? And so if management isn't careful and they disproportionately allocate those fixed costs, it may appear as though a segment isn't profitable when in fact what has happened is that the fixed costs have been allocated incorrectly, causing it to appear unprofitable. And so this is where you want to be really careful when making determinations about whether we're going to keep a segment versus eliminate it, or in this case, a product line. So in this example, we've got Snowbucks Inc., and they've got three product lines: the snow boots, the snow sporting equipment, and a clothing line for winter sports. And senior management has been told, hey, the snow boot product line is unprofitable. So do we want to eliminate those? And again, it looks as though this is an unprofitable segment. But what happens if you just hack out the snow boots? Well, you have allocated a fairly sizable portion of your fixed costs to the snow boots section. If you then have to reallocate those across the other segments, what does that do to your profitability of your other segments? Was this a reasonable allocation to be making, given that the snow boots are not selling? They basically can't be sold for as much as the sporting equipment or the clothing line. And maybe that answer is this is a fair allocation. If it in fact turns out that the snow boots is hugely intensive in terms of its drain of resources on the fixed selling and administrative, this could be a very reasonable allocation to it. And it might justify elimination because it is draining resources that are being paid for by the other two segments. So looking carefully at how that decision, that allocation of those fixed costs is really critical. Now, if it turns out that the snow boots is pretty self-sufficient and it really has very little drain on the fixed selling and administrative side of things, is it reasonable to continue to allocate in this way? And so perhaps this, what might appear unprofitable at a reallocation, perhaps based on proportion of revenue, might make this look a whole lot less unprofitable. So I just did some really quick math on the side here, and what I determined is that the fixed costs overall are about 16-ish% of the overall sales. Yet when we come over here to the snow boot section, the fixed costs allocated to it are closer to 18% of its sales revenue. And is that a reasonable allocation? Well, if it's really in fact using that proportion of the resources, but if the proportion is based on sales revenue, then we have over allocated fixed and administrative expenses to this particular product line. Now, when I made that adjustment just based on the proportion to selling, it wasn't enough to turn this segment into a profitable one, but it was certainly far more helpful. It lost a whole lot less money when I did it that way, and certainly reallocating that to the other two product lines would make this look less unprofitable and these less profitable. Now, if we take those same snow boots costs and we kind of reshuffle them and allocate this a different way, this starts to look a little bit different. We still have our same sales figures across the three lines, but we look at our variable expenses and we are then left with our contribution margin. What is our contribution margin? It is basically what is left over after we've sold an item and we've covered the cost to manufacture it. It's the portion of the proceeds that is left to cover overhead. So that has us at $532,000 for the snow boots. And we've got some avoidable costs if we were to eliminate, this is from a supervisor's salary. So if any of these segments were eliminated, we would get rid of the supervisor cost. And so, but despite that, we're showing that if we just look at it from a variable cost standpoint, this is profitable. It well covers what it costs to make it. And in fact, the problem in our prior example had to do with the way that we had allocated the overhead. So allocation of overhead is really critical. When I had done it as a proportion of sales, it helped to level this out, but not quite enough to make it profitable. But if we look at it just from the standpoint of whether or not it is throwing 457,000 a year toward the overall overhead budget. And without that 457,000 a year toward overhead, that 457 would somehow have to be absorbed in both the other two clothing or product lines. And so because it is contributing toward overhead, this would, based on this analysis, be a product line that we would maintain. And I'm going to actually stop this video here and go on to maybe the last video to talk about whether to sell or process further.